This week on Lewis on the Law, I have yet another great show for you. I have attorney D.A. Wilson on with me, and we're going to talk about land transactions and the taxes associated with those.
Welcome to Lewis on the Law.
You are listening to Lewis on the Law, and I have yet another awesome show for you. We're bringing it to you real here. I have attorney D.A. Wilson on with me. What's shaking, D.A.?
Oh, man, I'm happy to be back. This is my third time, and you've got a brand new background and new lights.
New cameras. We're shooting in high definition, 4K.
You're blowing up, man.
I know.
I'm excited.
What can I say? Things are happening. The magic is happening right now. So we are really trying to empower our listeners. It is tax season still. It's ongoing. It never stops.
It never stops.
That's right. So we're going to talk about taxation and land transactions. That's a big topic, isn't it?
Oh yeah. It's an exciting topic. I'm happy to come here today and just flush out some issues that some people may be having and may be struggling with.
So are taxes involved with land transactions? Are those different from regular taxes?
Yeah. Well, the first thing to remember or to think about in real estate is that it is very niched or nuanced, right? So, most people are attracted to real estate in many ways. You could be a homeowner, right? You could it could be an investor. You could be a landlord. You could be someone who has a big corporate job and just wants to leverage their good credit and their income to get property. So it attracts, all walks of life. So it's a very unique industry.
Okay, so we're talking about investing in real estate, basically, right? And the taxes associated with it?
Yeah. So
or just transactions, period?
Well, so it's really on the commercial side. Individuals that say, hey, I want to make this part of my business portfolio in a sense. Not necessarily on the individual primary residence. But we're going to talk about, what happens when someone says, hey, I want to buy a piece of property and either flip it, I want to rent it out to someone else, right? I may want to hold it for a long term, and then ultimately sell it for investment or business purposes.
Okay, so you can actually make these real estate transactions, though, make money for you, though,
Oh,
right?
Absolutely. As I said before, real estate is a very unique industry. It's the largest from an economic standpoint, the largest industry in the country. So, everything that we do rests on real estate. And so unless someone figures out how to levitate and work, it's always going to be a big part of everything that we do.
Okay, so I heard Warren Buffett say that because capital gains taxes are less than income tax, that he actually pays less than his secretary at work.
Absolutely.
That's crazy.
Yeah. We'll talk about that in a bit, but capital gains tax, that's a big benefit of being in real estate. And Warren Buffett is a big investor. I'm sure he does real estate, stocks, bonds, and everything. But for the most part, he is a capital gains tax person. It's how he gets paid and how he pays taxes, which is a lot less than what is called ordinary tax.
So what is gain?
So let's start at a topic called tax basis, right? So and it actually feeds right into gain.
Okay. Because the word sounds a little funny. They're just like, so you gain money, but if you earn it, it's different.
Yeah. Well, gain is what the IRS says it is. So if they say it's gain, it is.
Okay.
But when someone buys a piece of real estate, it's very unique. They may buy a piece of real estate for $50,000 and say, I want to rent it out, I want to flip it, whatever the case is. At that point, you have something what is called, tax basis. That's your tax basis. And that's something that you always need to keep up with and track, and it can go up and down. But in this situation, if you buy a piece of property for, let's say, $50,000 and you sell it for $50,000, there's no gain. The value, the appreciation of the property, there was none, and therefore you're just having a return of your initial capital, your initial investment. And so there's nothing that the Internal Revenue Service can knock on your door and ask you to tax you about. Now, the gain in which you speak of is when you buy a piece of property for $50,000. It appreciates. It could be in 10 years or over the years or whatever the case is. Appreciates to $100,000, and you sell it for that $100,000. The difference between what you bought it for, the cost, the tax basis at that point, and the difference between what you sold it for, which is 100 minus 50, is $50,000 worth of gain, and that gain is what you're going to be taxed on.
Okay, now does interest detract from that gain? Say you bought the property for $50,000, over the life term of that loan, you have $12,000 of interest, so it's $62,000. Does that factor into how much gain? Say you sell it at $100,000, is that factoring into the gain?
Well, interest is, and we'll go into that in great detail too. But interest is typically a deduction that you can take throughout the years, right?
So interest doesn't actually factor into the gain. Then.
No,
Okay.
it does not factor into the gain. Now, the depreciation of the property, and we'll talk about that in a moment. But the depreciation of the property is something that you absolutely can factor into that gain. And so, again, understanding from the very beginning, hey, I'm buying a piece of property. At some point, I want to sell it. If I sold it, what would I be taxed on, right? I would be taxed on the difference between what I purchased it for and what it sold for. And then that's, what the capital gains rate, we'll talk about that more, maybe 20%, So that's kind of a general quick kind of overview. Like a lot of times I see clients who don't understand the mechanics of that, right? And then there's other topics of, what happens if I decide to gift my piece of property to my spouse or to my friend, right? And I bought it for $50,000 and I gifted it to someone else. Well, in that situation, the same example that we used before, my tax basis just transfers from me to you or me to my wife, right? So if I bought it for $50,000, it appreciates for $100,000, I give it to you. My tax basis remains the same with the person that I gave it to. If they sold it, they're going to have the same.
Wait a minute. Let's slow down here. Okay, so you bought the property for $50,000. You give it to someone else. So who is paying taxes on that transaction?
Yeah. So ultimately, at the point of sale, right? So
now a gift isn't exactly a sale.
No. A gift is not classified as a sale.
But at the point of sale, say that person sells it. Okay.
The person who I gave it to at the point that they sold it, they're going to essentially inherit my tax basis.
Okay, got it.
Right. And so that's important because this and I talk about tax basis a lot, but a lot of times it gets confused with the term equity. Most people are familiar with, I have equity in my home, I have equity in a piece of property. There's a difference. The equity is assets, fair market value versus liability, right? So if you have you own a home, there's a mortgage on it, and it's worth something, you subtract it to, and that's how much equity that you have in it. And that's great for the purpose of, what you're going to take home. Well, exactly like what part is owned. But the IRS is more concerned of what is your tax basis, James. They want to know how much money do you have invested in this property and what did you sell it for? And based on the difference between the two, then we need to get a portion or tax a portion of that. And so, a large part of the discussion that we're going to talk about is, how do you deal with it? How do you minimize this portion that the Internal Revenue Service is going to ask for? Because, and I had this conversation with all my clients. This is not an original thought. I got it from my professor in Boston. And he told me, he said, what most people don't realize is that when you enter in some type of business or commercial activity, the Internal Revenue Service, the federal government, is your silent partner, right?
They just take right?
They're going to get a cut.
They give goods and services.
No, I mean, nothing against the federal government. They do a lot of amazing things, but they're also your silent partner in all economic activity. Yeah. And so you have to enter into these transactions thinking about that. What is my take home? What is my cut? I just can't assume that, hey, I have a $50,000 gain in that example that I gave before and think that's all mine. It's in fact not all yours. And so finding out ways to ethically, minimize or reduce those tax burdens is extremely important. Okay. And it's extremely important to consider these things from the beginning. And I think that's something I didn't say well enough early on. We want to have these conversations from the beginning. You're buying a piece of property, you may want to sell it. How can you cut out that silent partner? And
probably some of the interest that's applied to that loan that you initially got is a way to begin minimizing.
Absolutely,
some of the
absolutely. And many real estate ventures are leveraged, and they have loans and mortgages and things of that nature. And so those are ordinary business deductions that you can write off on an annual basis. Much like the interest on our student loans.
Right? There's a lot of that.
There's a lot of that, man.
Have you ever been to law school? You feel the pain. Okay, we're almost at the end of this segment. DA, why don't you give them some quick contact information for you?
Yeah, great. So I am David Wilson, or DA Wilson. I go by DA. I am a founder and managing attorney of the Wilson Firm. My phone number is 470-223-8271. Email address is da@wilsonfirmatlanta.
You're listening to Lewis on the Law. My name is James Lewis. I am your host this week and every week, and I bring you information to empower you, the listener. That's right. Even if you're ignorant of the law deeply affects you. And by listening to my show, you begin to understand exactly how it affects you. This show is not meant to replace the advice of an attorney. If you have a serious legal issue, go ahead and contract with an attorney. You can always contact me at jameslewislegal.com. You can email me at james@jameslewislegal.com, or you can give me a phone call at 404-610-0075. All my old shows are archived on my website. You can go there. All the videos are on my website, or at least a lot of the videos are on my website. When we get back, we're going to get more into it. We're going to talk about depreciation, deductibles, all those things that you don't want to hear about, but you need to know about. Money, that's what it's all about, breaking it down. You're listening to Lewis on the Law. I have yet another awesome show going. Why is it awesome? Because we're bringing you the type of information that you need. It's tax season, and it's really important. And some of you guys out there are movers and shakers, wheelers and dealers. You got your commercial transactions going. You got your land going. So you might want to get some insight on taxation associated with those land transactions. I have attorney D.A. Wilson with me from the Wilson firm. D.A., real quickly, hit them with your contact information one more time.
Yeah, D.A. Wilson of the Wilson firm. My email is da@wilsonfirmatlanta.com. Phone number is 470-223-8271.
Okay, when we left, we were talking about property that's acquired by a gift. But let's say it's not really a gift. Your granddad, you love your granddad. He, passed away, and he left you the family farm. How does that work in all of this?
That's it's sad that your grandfather passed, but the fact that he left you some land is a really cool thing.
So I got the family farm.
He left you something behind, right?
Uh-huh.
So, but no, this is an area of tax that really got me excited when I was in law school. And
only tax attorneys say, "Oh, this is an area of tax that really got me excited."
No, I mean, because it's one of the few areas where you don't have to pay taxes, right? And so, I run into clients who have this situation all the time. So there's a unique feature in the tax code that says, essentially, if you pass property down, real estate down, appreciated real estate down at death, you get a stepped-up tax basis, and you don't have to pay taxes. So how that operates?
Wait, stepped-up tax basis? What is that?
Yeah. So the example from before, right?
Uh-huh.
You've got a piece of property.
We kind of got to tax basis. I understand tax basis. Stepped-up tax basis.
Yeah. So you bought the piece of property for $50,000. Your grandfather purchased it, rather, right?
Yeah.
It's appreciated to $100,000.
Yeah.
If he had sold that piece of property or gave it to you and you sold it, you would have paid what we talked about as the difference, right?
Mm-hmm.
But the stepped-up tax basis provision says that, hey, listen, if he passes away and leaves that to you at his death, the property has appreciated to $100,000. You can then receive that property and sell it and not pay a dime, right?
So that's the step up.
That's
Uh-huh.
stepped up to the fair market value at the time of death.
Okay,
right?
got
And
it.
so you can see where this is just really cool, and you can see the benefit of leaving appreciated property at death as opposed to gifting it or giving it away prior to death. And this is good for not only real estate, but stocks and other things. So, I mean, you can use this example in so many different ways. At professional sports, you got a professional sports team that was bought for $100,000 or $1 million, and now it's worth $10 million. And you say, I'm going to leave this in the family, and you can have my interest at death. That team can be sold at death, and now, or the property, or whatever the case is, and now you don't, the next generation, in theory, doesn't have to pay taxes on it. Now, there are some estate tax issues that go into it, but they've all but done away with the estate tax. So this is a really cool thing.
Let's break this down a little bit. Okay, so your grandfather's property was $50,000 when he bought it. When he dies, it's $100,000. So if you sell the property at that point, that part of it is tax free.
Yeah.
But what if you hold on to the property for another 10 years and it raises to $120,000?
Yeah. Then you receive the property at that $100,000 tax basis. That stepped up
so
tax
that's
basis.
your tax basis
Going forward, and then you sell it for whatever, and then you pay the difference between the two.
So you're on the hook for the $20,000.
Just on the difference. Now, and that's the key. You have to sell it, at the tax basis that it's worth, but still you can see where the appreciation of value in receiving something at death is a great estate planning, a generational tool. So, like I said, I studied that in law school, and I was like, wow, that's really cool that I can leave something to my son or my daughter that's appreciated, as opposed to giving it to them prematurely and paying a bunch of taxes on it.
Yeah, I love all the little tax loopholes, the way you can get income free of taxes, the way you can get tax credits that are worth 2 or 3 times the money you put into it.
Yeah,
those do exist too.
Yeah. There are all types of different things that you can do to save money, and we're here to discuss it.
Okay, now this next topic, I know very little about it. Deductible expenses versus capital expenditures.
Yeah, so this is a situation where an individual has purchased some property, and now they're actually in the operation stage, right? Like you've purchased it, you didn't give it away or anything. And I run into this a lot. There's honestly a lot of bad advice. What type of expenses or costs really are going to be deductible right away every year, and what aren't going to be deductible, right? And so it's a very kind of nuanced area of tax, but it's important because a lot of times it's abused, right? And so I'm always advising my clients on making sure that hey, before I get into this property, I need to be able to look at what expenses can I write off right away, which is a benefit for me, and what expenses do I have to use as what is called a capital expenditure, which essentially is what must be added to that famous word tax basis.
Okay, tax basis. What has to be added to the tax basis? The $20,000 in the last example we gave.
It is exactly. So I'll give you an example, right? Someone purchased that same piece of property for $50,000, right? And then they say, "Hey, listen, I've got to repair a roof," right? What is that roof? Right, with the cost of it, if it's, let's say, $15,000, how is the IRS going to treat that? Are they going to allow you to write that off on your taxes the next day, right? Deduct it, write it off, deduct it, the same thing. Or are they going to force you to say, nope, it's not a write-off. You need to add that on to your tax basis to that $50,000. And when you sell the property, that's when you will reap the benefits of that expense, of that cost.
And how does that go down? What does the IRS say about that?
Well, what they're going to say is if you repair a roof, it's going to be called an improvement, right? So there's a difference between deductible expenses or improvements. It's very important for.
I'm hanging on the limb here. Is that a deductible expense or is it a capital expenditure?
No, it's a capital expenditure, 100%. Okay. It's 100%, and that's some areas that I run into real estate clients with. And they may have been misadvised. They think that they can pump a bunch of money into their property and write it off right away. But they really cannot reap the benefits of that roof, repairing that roof, until they sell the property. And that may be 5, 10, 15 years down the line. So are you willing to put this type of investment into the real estate when you can't immediately write it off? When the only time that you can reap the benefits of it is when you're selling the property, which, again, is going to be a long time for most people. So understanding from the very beginning, hey, I've got some expenses, things that pop up, right? And we'll go over some more things like routine maintenance, right? You may need somebody to come and cut the grass or things. Those type of things absolutely can be written off. There's no problem with that. But when you get to the point where you're taking a piece of property and you're starting to improve it, you're starting to make it better, the IRS really gets particular about that. And they say, because you're taking this piece of property and you're trying to improve it, we're not going to let you write it off. And so there's a very fine line with those expenses. And the best way to know it is to know, what an improvement is and what it's not. And so it can get very, knick-knack, but the bottom line is having that conversation early on before you purchase the piece of property. Hey, this is going to need new shingles. This is going to need new carpet. How will the IRS treat these expenses, these costs?
Okay, now I think you've kind of illustrated what a capital expenditure is. So what exactly fits into the deductible expenses?
Everything that's not a capital expenditure.
Oh, no. Ouch. I was afraid you were going to say something like that.
No, so I'll give you an example, right?
Give us an example here to make this a little clearer.
So let's say that you do have
fixing the roof is not. That's a capital expenditure. It's an improvement to the structure.
Yeah. Well, let's say that you have maybe a corner of the roof that needs to be repaired, right? Some patchwork, some things of that nature. That is something that can be argued that is just an expense and can be deducted. Right, and so some people say, and it's a case by case. It depends on who your tax professional is. Some people say if you tip over the 50% threshold, and of course we live in a tax world, at least in the United States, where it's self-reporting, right? So nobody's going to make you say what it is or what it isn't, but at least you need to know, hey, I repaired 15% of this roof. I should be able to write that off. But I repaired 65-70% of it. It's going to be very difficult. So understanding things like that, right? You may have a toilet. A toilet may need a handle replaced on it, right? Whereas I need to change the entire toilet. There's a big difference between the handle and the entire toilet. So the handle, likely to be deductible, you can write that off. You change the entire toilet, a tub, you put a new bedroom, a new garage, those are improvements. And so I think most people can understand, the term improvement, but there is a science between what is it going to be. And so the most important thing, I say this, is talk to your tax advisor. You're looking at a piece of property, have them look at each room, the roof, the whole property, and say, okay, I think this property is going to need $15,000 worth of improvements and maybe $5,000 worth of just general repairs that we can write off. That type of analysis will really push you to say, okay, I can take on this project. Instead of getting into it, making all these costs, then IRS kicks them back. Now you're getting audited and things blow up.
Now, this sounds like an area where you definitely need a tax professional. Now, DA, we're coming towards the end of the segment. Why don't you give them some contact information for you once again?
Yeah, the Wilson Firm, DA at Wilson Firm Atlanta. My phone number is 470-223-8271, and website is wilsonfirmatlanta.com.
You're listening to Lewis on the Law. My name is James Lewis. I am your host this week and every week. And if you have a topic that you'd like to hear on this program, go ahead and contact me on my webpage. On the very last page, there's a contact page. Drop me a line. Tell me a little bit about the topic that you'd like to hear brought on air. And if I can't answer your topic, I'll bring an attorney on who actually knows something about your area, and we will talk about it on air. If you would like to find an attorney, you can always contact me. I have a lot of attorneys that come onto this show, and I can direct you to the best type of attorney that you might need. This show is designed to give you information to help you take your first step in the legal process. It'll help you decide what type of issues you need to pay attention to, what type of attorney you're looking for. We're here to give you just that little bit of help. You're listening to Lewis on the Law. When we get back, we're going to talk about that really funny word, depreciation. No one ever understands what depreciation means. You are listening to Lewis on the Law, and once again, here at Lewis on the Law, we are bringing it to you. That's right, the information you need. It is tax season. You need to have all the information you can. I know some of you guys out there are wheelers and dealers. You're moving property from one hand to the other. I know. I get it. I'm with you guys. I love you guys. Anyways, I've got attorney D.A. Wilson on with me from the Wilson Firm. D.A., one more time, some contact information for you.
Yeah, the Wilson Firm email is DA at wilsonfirmatlanta. Phone number is 470-223-8271, and website is wilsonfirmatlanta.com.
And we are talking about taxes that are associated with land transactions. And, of course, there's always this word, depreciation. You hear it all the time. What the heck does that mean?
So depreciation is tricky, but it's a great thing, right? So we've been talking about property as if you buy it and it's just this one price, right? It is one price, but it's split into two halves, right? The land is worth something, and the fixtures, the building, the structure is worth something else, right? And in the commercial sense, that's very, very important because you can take a depreciation against the building, the structure, but not the land.
Of course, land never depreciates. It always appreciates. Or rarely. I guess during the bubbles it does.
Yeah. In 2007 and 8 it did. But
ouch. That was a bad time.
Yeah. So it's unique. We've been using this fictitious $50,000 property the whole time, right? More than likely, or not more than likely, but when you buy that piece of property, it's going to say, hey, the land was worth, for example, $25,000 and the house was worth $25,000, right? So now you're like, okay, great. I've got a tenant in there, or I've got a commercial building, such as this building. Great. I can now take the building structure at $25,000 and I can depreciate it over time.
Okay, so wait a minute. What does depreciation mean? What does that word actually mean?
So the depreciation is pretty simple. It's basically saying I can take the value of that property and break it up into, so for commercial properties, it's 39 years, right? Mm-hmm. Over 39 years, I can break up that $25,000 and take a deduction for that value.
Okay, so you basically take a little bit of deduction for every single year. Is that the way it works?
Yep. And make sure you remember it's the value of the structure and not the land. But I can take a depreciation deduction. We talked about deductions a moment ago. They're good things for business owners.
Yep.
So if you got income, you can write off, $25,000 divided by 39 years. And whatever that, I don't know what it is off the top of my head, but whatever it is, every year for the most part, you can take that deduction.
The good thing is the IRS has little tables that actually lay out exactly how much deduction you can actually take.
I mean, they're very transparent. I mean, there's calculators that formulate these things. But again, this is a planning feature. This is me saying, okay, I'm buying a piece of property. It could be that the land is worth way more than the building structure, or the building structure is worth way more than the land. And because of that, now you've got either a large deduction or a small deduction. And so that's something to consider from the very beginning. And it's very easy to consider or think about. It's like, okay, well, I see the value of this. I see the allocation on the purchase price to the property, to the actual structure of the building. Wow, I can write a portion of that off every year.
Okay, so I think we kind of got around what depreciation actually is. And once again, the IRS has tables on that. So this topic, recapture of depreciation on the sale of depreciable real property, what does that mean?
Yeah, so
that's a lot of words in there.
Yeah, so in
all these words, they're so big.
Yeah, and so one thing I didn't flush out well enough before is the effect that depreciation has on that original tax basis of $50,000, right? And so if you take those deductions, because you've taken them.
I think this is pretty important. Okay, go ahead. Sorry.
Because you've taken them. Let's say you take $1,000 in depreciable land. Now you have to decrease your taxable basis by that $1,000. So now you have $49,000 of taxable basis. And when you sell the property, right, now you have more gain to be taxed on.
Yeah, so you're going to get hit. So even though you're taking it off your taxes here on the front end, on the back end, when you're actually ready to sell the property, you're going to get hit for all that, all the income that you basically make.
Absolutely. And so this is weird to explain, but it goes into capital gains a little bit. The problem with that is when you took your depreciation deduction, there's two really types of income out there. There's capital gain, which is taxed at a high end at 20%, and there's ordinary income. The ordinary income, we work at a law firm and pay ordinary taxes. Everybody who works pays ordinary taxes, get taxed at a high end about 36, 37%. And so you took a deduction off of 36, 37%. And so what the recapture of this property is like, now that your property is appreciated and you sold it, we can't let you get a capital gains tax treatment when you took an ordinary tax deduction. So in short, and it's a weird theory, but in short, you got to pay about 25% instead of that 20% that you would ordinarily pay.
Okay.
And so just know this, the deductions that you have taken will be accounted for upon sale.
And that's the recapture part.
And that's the
recapture part of this whole thing.
And that's the recapture. And I want to break it down. Like, nobody uses recapture on an ordinary basis. I don't think I've ever used it outside of tax. And so I want to liken recapture to understanding, like, hey, I took deductions. The property value appreciated over time. When I sell my property, I have to answer for those deductions that I took.
Okay, so that is the recapture. So So did I hear you correctly that that is not taxed at the same rate as capital gains? Is that correct?
Yeah. So, the
because it seems like that would be a capital gain.
It would be, and it's very weird, and because they allowed you to take this, what is called ordinary tax deduction, right? The W-2 tax rate deduction. You took a deduction off of 37 cents on a dollar if you're in the high end, right? Now we're gonna say, hey, we got to make that right, and it's really hard to calculate. So essentially, they just kind of say, hey, you're gonna pay 25%. Right. And so they kind of penalize you just a little bit because you haven't taken a capital gains rate. Now, it's kind of confusing because we haven't touched capital gains yet, but I think it'll make more sense as we kind of push through the material.
Okay. Well, why don't we touch capital gains a little bit? What exactly? So we've been talking a lot about it here. Let's break capital. What are capital gains?
Yeah. So
what qualifies as capital gains? Because here you gave a situation where you would think that would qualify, or just in when you touch the word capital gains, you think that would qualify as a capital gain.
Yeah. So capital gains are probably outside of the stepped up tax bases when someone passes away. Mm-hmm. In my opinion, the capital gains are the coolest part of being in real estate, right? It's first of all, you have to have a capital asset, and real estate qualifies for a capital asset, right?
Are there other capital assets?
Oh, absolutely. Stocks is another capital asset that qualify for this very favorable treatment. But for the purpose of what we're talking about here, it's real estate. Real estate is a capital asset. The tricky thing about capital assets is in order to really reap the true benefits, which is a lower tax rate, you must hold it for more than a year.
Okay.
And so that favorable tax rate is a ceiling of 20%, right?
Yeah, that's what you're going for.
Yeah.
The Warren Buffett tax rate.
Yeah, absolutely. So if you say, hey, listen, I can now reduce my tax rate from a high end of 37% to 20%. I mean, that's a significant savings.
It is.
And so one of the things that it pains me when I'm dealing with clients in real estate, one of the things that really pains me is that they say, oh, yeah, I just want to, buy and flip properties. And you buy it, you improve it, and you sell it in 6 months. Well, because you have sold it in 6 months, it's a capital asset, but you haven't held it for more than a year.
For the qualifying period of time.
Yeah.
Okay.
So now you don't get a chance to tap into a shrink tax rate.
So if you do sell it after the qualifying period of time, then it becomes a capital gain?
Yeah, it becomes a capital gain. Now, and I tell a lot of my landlords this: just buy the piece of property, improve it, put a tenant in it for a year, sell it afterwards, right? Now you're going to save yourself, it could be, and we're using numbers as if we know what an individual tax rate is for everyone, but we're just using the high end 36, 37%. Now you get a chance to really take advantage of that. And so it pains me when I'm dealing with a real estate investor and they're just buying and flipping and buying and flipping and buying and flipping. And you're missing, in my mind, one of the most valuable components of real estate, which is a much lower tax bracket.
Yeah, it's the gold standard, right?
I mean, it doesn't get much better than that. I mean, and I'll be honest. I said 20%, but depending on your income, it ranges from 15 to 20%.
Yeah, exactly.
So,
if you're making the millions.
Yeah, I always use the high because we want to be millionaires, right?
Yeah, right.
So, but honestly though,
at least I got a little work to do.
I got a long ways to go for that, but I know what to do when I get it.
There you go.
But again, that 15 to 20% is such an amazing way to save money and really save value, and it's one of the reasons why real estate is so attractive and so lucrative as well.
Okay, so we're up against the end of this segment. DA, one more time, some contact information for you.
Yeah, the Wilson Firm here in Atlanta, Georgia. DA at Wilson Firm Atlanta. My phone number is 470-223-8271.
You're listening to Lewis on the Law. My name is James Lewis. I am an attorney. I can always help you at least find your way through a legal solution. You can always just give me a call at 404-610-0075. If you have an idea for my show, you go ahead and go to my website, jameslewislegal.com, and go ahead and hit me on my contact page. You can drop me a line, let me know a little bit of the situation that you'd like to hear talked about or that you need an attorney to help you with, and I will get back in touch with you. You can always give me a call at 404-610-0075. You can also email me at james@jameslewislegal.com. This show is not meant to replace the advice of an attorney. If you have a serious legal issue, go ahead and contract with an attorney. This show is only here to provide you legal information. We are only designed to be a first step in your legal process. We may help you clear up issues. We may help you know what types of things you need to save, what types of things you need to talk about to an attorney about, or even what type of attorney you're looking for. Once again, when we get back, we've talked about capital gains. We're going to talk about losses because, how does that factor into it? Tax deferral opportunities, all kinds of good stuff. You're listening to Lewis on the Law. You're listening to Lewis on the Law. My name is James Lewis, and it is all about money, and we are trying to help you keep as much money as you possibly can. We are talking about taxes. That's right, taxes associated with land transactions. I am honored to have, yet again, attorney D.A. Wilson on with me from the Wilson firm. D.A., let them know how they can get in touch with you.
Yeah, sure. So it's D.A. Wilson, D.A. at Wilson Firm Atlanta. The phone number is 470-223-8271. And the website is wilsonfirmatlanta.com.
Okay, so we have gone through a lot of information. DA, can you just kind of wrap up where we've been? Because we've thrown a lot of stuff at our listeners and people start to hear all these words. And it's like when I first got to law school, I'm like, all these words. Yeah. They want me to read all these words.
It's pretty bad. I know tax jargon is tough, but we started off just talking about understanding what tax basis is and how important that is to track throughout the entire process of owning real estate. We talked about the various deductions that you could take advantage of, things that aren't going to be deducted that you have to capitalize, right? And we talked about being able to shrink your tax basis through depreciation, which is super important. And then we talked about, what happens when you sell your property, right? Now, how am I going to be taxed? And how long do I need to hold my piece of property, my real estate, in order to not pay, those ordinary tax rates, in spite of me having a capital asset, which can be very confusing. You can have a capital asset that's taxed by ordinary income, or you can have a capital asset that is taxed as a capital asset with capital gains,
which is much better. And we also talked a little bit about property acquired by gift,
absolutely,
versus property acquired from your grandfather's will.
Absolutely. There's a big difference between someone gifting you property and passing it along at death. And I think we all agree that receiving it at death is much better.
Yeah, it is. You're absolutely much better because you get a big chunk that becomes tax free or tax non-included. So this is exciting. Where are we at now?
So now we're going to talk about different tax deferral options, right? One of the cool things about real estate, and as we're talking about in the recap, is what you can see is you have the ability to be able to pick and choose, if you're smart, how you want to be taxed and when you want to be taxed. The deferral mechanisms or options that are available for real estate are super cool. Because if you're using business as we're talking about, real estate as we're talking about today in the commercial, economic, and the business sense, you don't have to pay 20%, right? You can say, hey, 20% is much better than 36, 37%, but I don't have to use that. And this is so unique because, in what other industry can you say, hey, I sold something, I don't want it, and I don't want to pay taxes on it. And so the deferral mechanisms are probably the most popular one, or the 1031 like-kind exchanges. And so what sucked about the that's not politically correct, but what hurts about the new tax reform is the fact that a lot of the things that were like-kind exchange or qualify for this 1031 exchange no longer qualify. But real estate remain the same.
Okay. I want to slow this down a little bit. What exactly are you talking about when you say a tax deferral?
Absolutely. So tax deferral, most people can understand what a tax deferral is by understanding how their 401k works with their job, right? And so you make money, right, on your job, W-2 wage earner. You've made $50,000 and you say, hey, I want to throw $10,000 of that into my 401k, right? Because you've thrown that to your 401k, it's now tax deferred. It can't be taxed. So you're only going to be taxed on the difference between what you put in your 401k and the difference of what you actually took on, $50,000, which is $40,000. So that mechanism of earning something and saying, hey, federal government, I don't want to pay taxes on this. Let me put it into a separate account that's going to avoid taxes.
Hence the tax deferral.
Yeah, and that's the mechanics of deferring tax, and it works the exact same way for real estate.
Okay, so like-kind exchanges, what does that mean? What are we talking about here?
Yeah, so we're using our grandfather's. Well, let's not use the grandfather's farm because that's worth probably $1 billion at this point.
Yay!
But let's get back to our original example of that $50,000 piece of property that we purchased about an hour ago, right? And it's appreciated to $100,000. And say we're renting it out to the Atlanta Hawks or something like that. And we say, you know what? I want to sell this piece of property for $100, right? We've held it for a long time. We got capital gains treatment at 20%. But you say, you know what? I don't want to pay taxes on this, right? What I really want to do is just take this money and reinvest it into another property, another like-kind exchange. And so you take that money and you invest it into another commercial piece of property, right? And because you invested into a commercial piece of property, now you do not have to pay taxes on that $50,000 recognizable gain, would be $50,000 recognizable gain. Now, there's some strict requirements to that, and this is where a lot of people get dinged. The first thing is you must have a qualified intermediary, right? You must have somebody, and it can't be a lawyer or a family member. It has to be like a third uninterested party to receive those sale proceeds. You physically cannot have receipt of those funds, not for a day, not for a minute. Right? And so you have to line up that qualified intermediary to receive those funds, to hold those funds, to identify those funds, to identify the next target property within 45 days. And then within another 180 days, you have to effectuate that sale.
Okay.
So there's
So it's best to have these sales lined up.
It's all in the planning. It's all in the
Mm-hmm.
planning. I mean, there's case law. We study cases where someone received a piece of property and they took the funds, they took a check, and that destroyed the ability for them to be able to do a 1031 like-kind exchange. And so now they're having to pay taxes, even if they rolled it over into another property. Right now they have to pay taxes on money that's not even there. It's been rolled over into another property, but because you didn't execute the like-kind exchange the right way, then you run afoul. So super important, to recap that, and there's some other mechanics, but a qualified intermediary, right? It can't be your attorney. It has to be someone, and there's plenty of definitions for that, right? 45 days, you need to identify that target property. It could be 3 different properties. You could say, I want to purchase property A, B, and C. You don't have to purchase all of them, right? But you need to communicate, these are my 3 target properties. And within 180 days of the sale, you must purchase that property, right? And the 45-day and 180-day, they run together. So, it's essentially 180 days from the actual sale. So, but again, this is a really cool feature that kind of caps our discussion here. We got a little bit more to go, but it caps our discussion and it shows you, the discretion that a real estate person has. They can pick and choose when they want to pay taxes. And that is a significant advantage over any other industry where a lot of people are forced, right? And in the stock and bond industry, they were once a part of that 1031 exchange, but it's been eliminated to a large degree. And so they no longer can take advantage of things of that nature. Okay.
That sounds like an incredible opportunity. 1031 exchanges is actually one of the areas that it seems like people really search for you online for.
Yeah. I mean, you definitely need an attorney to walk you through the mechanics of that, understanding the tax basis, understanding what improvements, what's even subject to being taxed. It's super important from the beginning. And you hear the warnings on TV. Don't try this at home. Definitely,
don't try that at home.
Don't try a 1031 exchange at home. Hire an attorney. It could save you.
Well, I think most people wouldn't understand a 1031 exchange unless they were a tax specialist or an attorney.
Yeah, very true. Very true.
Okay, so how do qualified opportunity zones fit into this?
Yeah, so a qualified opportunity zone. This is cutting edge stuff here. This stuff was rolled out.
Love it.
in 2017, December 2017, new tax bill, tax law, and it went into effect. Well, the zones that we're talking about now were designated around April. At least the ones in Georgia. There's 260 zones in Georgia.
And I think we touched a little bit on this on another show of mine, but go ahead.
Yeah, and it's very, very nuanced, but the gist of it is there are certain areas and certain zones that each state can designate as basically areas that they want to be economically improved, that are down and out, and that could use some help for investors. And it works similar to the 1031 exchange, but a little bit broader, right? So now an individual can say, hey, listen, I may have some stock in Apple that's appreciated. I can take that gain and reinvest it into what is called a qualified opportunity fund and find one of those Georgia 260 qualified opportunity zones in Georgia and reinvest that cash or the stock from the fund into those zones, and I can have another tax deferral mechanism.
Now, when you're talking about reinvest, what are you talking about? Are you talking about investing in a business, or are you talking about buying land?
Yeah, so it's one of the weird things about it is you have to take the cash and invest in a business's stock.
Okay, you have to invest
in
stock.
And the business buys the actual property. And it has to be in one of those zones. So it's 260 zones in Georgia, and there's maps online. It's amazing. There's a bunch of different zones.
It's odd that downtown Atlanta is in one of those qualified opportunities.
Yeah.
It's really odd.
It's very weird. There's zones all over the place, and Georgia has some of their own zones and such. But it's very weird. But the short of it is, there's great opportunity for you to defer outside of the 1031 exchange using stock and other appreciated assets.
Love it. This is cutting edge stuff. And believe it or not, you listeners out there, you might actually gain something if you actually are interested in this. You might want to talk to an attorney and see if you can get into some of these opportunities. Credits are good. Credits are better than deductions.
Yes.
Credits are good. You're listening to Lewis on the Law. DA, real quickly, give them some contact information for you. We're at the end of our show.
Yeah, great. So it's DA Wilson of the Wilson Firm. My office is located in downtown Atlanta. Website is wilsonfirmatlanta.com. Email is da@wilsonfirmatlanta. And phone number is 470-223-8271.
You're listening to Lewis on the Law. Before we leave, I have to thank the guys that are making the magic happen here. Anthony Cook back there making the videos come to life. That's right, the magician of multimedia. And our siren of sound over here, Sam Davis, bringing it to you live. You're listening to Lewis on the Law.